Thank you very much. Could you all tell that that picture was taken 3 logos ago and when I was maybe 20 years younger? But in any case, so I'm an economist, as Greg said, so please don't hate me for that. And if you need to get up and get some coffee, please do so. And hopefully this won't be as bad as Econ 101 if you ever had that. So what I'm going to do here is to first give you an overview of national trends, because what's happening in the nation is going to affect you here in Indiana. So I'll take just a few minutes to do that. Then I'll talk about your region. And we're going to look at your region as it's defined proper, but we're also going to look at the labor shed, and I'll explain to you why we look at a labor shed. The data for your region shows that you're growing slower than the nation. The largest sector is education, so we'll drill down a little bit on the education sector. It provides stable growth, it provides fairly high wages, and then your second largest sector is the manufacturing sector, and it provides high wages as well, but it's volatile. When we go into a downturn in the business cycle, you see a drop-off in manufacturing employment greater than you see in other industries overall. And then when we look to the future, your growth rate over the next 10 years, given your current industry mix, is expected to be much slower than the nation, and I'll give you some background on why that is. So first, starting with the national economy. This is gross domestic product. It's the broadest indicator of economic activity, and it's hard to see, but there's a gray shaded area here showing you the last recession, the Great Recession, and you could see how deep it was compared to the previous recession. Looking forward, the growth has been modest. You would think if we were in such a deep recession, we'd have a bigger rebound, but most recently, we have a bit of a pickup. So we got to 3% growth here in the last quarter, the second quarter, but when we see the next 2 quarters, they're going to be kind of misleading because we've had the hurricanes, which are going to cause the growth rate to be a bit slow. So to give you an idea about that, Harvey was about 60 to 108 billion in cost. Irma, the estimates are up to 83 billion in cost for that hurricane. To give that into perspective, the 3 most costly hurricanes in 2017 dollars since 1980 are first Andrew, $47 billion, and you remember that one coming through Dade County. In 2016, we had Sandy, that was $70 billion, and then Katrina, that we all remember, $160 billion. So these 2 hurricanes together could be more than what we saw with Katrina, and we don't even have Maria in these numbers yet. So that we expect, again, to have an impact on the third and the fourth quarter, and then near-term negative impact, of course, the loss of life, damage to infrastructures that have to be rebuilt, businesses closed, some forever, and all their employees are laid off for a period of time. So reconstruction efforts, however, will then boost the economy in the first couple quarters of next year. So in terms of our forecast, as we see it anyway, is here's GDP at the top. Notice the slow growth that we had here and a pickup. This does not take into account the hurricanes, so next 2 quarters, a little bit less, 2 quarters after that, more than we're showing. I just spent an hour yesterday talking about the national economy, so if we have time during Q&A, and if you want to ask about some of Trump's policies or whatever, I'd be happy to try to address that. But just one thing to show you here, non-residential investment, notice how slow it was, and then it picked up when we had the election, and it stayed strong. Non-residential investments, buying equipment and plant, intellectual property. When we see businesses investing in non-real estate or non-residential investment, they're showing optimism that this economy is going to continue to grow. And with some of the Trump policies, if it ever does get passed by Congress, we should see some pickup in activity in the overall economy. Just a couple other things here. If there are any bankers here, we do have the Fed increasing the federal funds rate in the fourth quarter. And with higher inflation, you'd expect the 10-year and the Treasury, the 10-year and the mortgage rates to go up. So if you haven't refinanced or purchased your house, now's the time to do it because those rates will probably start going up. So defining the region. So your region is defined here as these 4 counties. And what you're seeing in the darker blue is the number of residents commuting to your region. So the darker area is more people commuting to your region. But in addition to people commuting to your region, you have residents here that are commuting outside the region. So now your region is shown in yellow, and the darker blue shows you where those people are commuting to. So when we think about economic development or workforce or educating the residents here, we really should be thinking about the labor shed. So the labor shed represents the reach of the population that works within your region. And that's very important because if you're on the economic development side, it's all about new companies or expanding companies want to know, do you have the workforce here to fill their jobs? And so we don't want to stop at the geographic boundary of your 4 counties. We want to take into account the people that drive into this area and what their skills are, so that when we talk to the firm, it'll be a larger number, a more accurate number of the occupations around the region. And then some of the residents that work here also, some of the residents that live here also work outside this region. So when the community colleges and when the training providers are trying to think about what offerings do we need to have, they shouldn't just take into account the industries that are within your 4 counties, but within the whole labor shed. So as I'm showing you data going forward here, I'm going to be talking sometimes about the region proper and sometimes about the labor shed. And I basically defined the labor shed. Here are the counties. Any county that has at least 800 people that either live in the area and work in the area or work outside of the area. So you can see those counties listed there. So before I go on to the economy and how your economy is doing, I'm going to spend just a few minutes on population, and it's really going to reflect locally what Kim had talked about nationally. So population here in your region proper, 303,000. In the labor shed, 621,000, so it's about doubled the size of your region. Annual average growth rate from 2006 to 2016, Southwest Indiana growing about 0.3% a year. The labor shed, the same, but the U.S. growing 0.8% a year. And by the way, these slides will be available on the websites. I know some of the charts will be kind of small and hard to read, so you can get access to that later. The U.S., though, growing 0.8. So this region, over the last 10 years, growing much slower than the nation in terms of population. If we look at a growth forecast that we've done here, going out to 2013, no change in the annual average growth rate of Southwest Indiana proper. The labor shed expected to grow just a tiny bit faster, but still about half the pace of the U.S. overall. Now, when we start to look at age cohorts, so here is the typical way that it's broken down for census, under 18 years, and in orange is the percent in Southwest Indiana, the lighter orange is the labor shed, and then the greenish blue is the U.S. So notice when we get to about the 25 to 34-year-olds, you see a smaller percentage in that cohort than you do in the U.S., same with the 35 to 44. This is not unusual in a county that's more rural, where you see people of this age group that are looking for opportunities and they leave to find them elsewhere. And then also not too unusual, we see a higher percent in the 65 to 74 and 75 and over age group within the region. Now this chart is showing you in blue the number of people in these age groups in 2010, and then the number of people in these age groups we expect in 2030. So in 2010, notice that you have a larger percent or larger number, age 25 to 34, and that goes down in 2030. And at the other extreme end, you have a larger number in 65 to 74 in 2030, and the same with the 75 and over. But this is something that's not just your region that's seeing this. We're seeing this trend across the entire nation, the graying of America that you heard Kim talking about. So this is actually a blog that we wrote, and if you were to go to this site, you can click on this play, and it will go through the whole time period here and show you the changing in the color of the nation. And these are all the counties. It's green if the largest number of people are 0 to 19. It's light blue if the largest number of people are 20 to 39, blue if they're 49 to 59, and 60 and plus if it's gray. So you don't see a whole lot of gray. You see some gray down in Florida as the predominant population group, which you would kind of expect. So what I'm going to do now is fast forward to 2030, and we see a graying of America. So here's your area here. You see maybe one little green, greenish blue, but we're seeing this shift across the whole United States. So now to economic growth. What I'm going to start with first is the overall growth rate. Employment is the broadest and most timely indicator when you get down to a regional level. And so here you're seeing Southwest Indiana, 9,418 jobs lost since you got, since you got to the bottom of the recession. Since 9,418 jobs have been gained since we hit the bottom after the recession, that's a 6.2% gain in jobs, a little less than what we saw in the nation, which is a 9.4% gain. So you are seeing growth a little bit slower than in the nation overall. When we look at the percent change from a year ago, now again I'm showing Southwest Indiana proper here in blue. The blue line is showing you the labor shed, and the U.S. is in black. So you've slowed down on a year-over-year basis, and I'll try to explain a little bit of this in the coming slides. When we look at the unemployment rate, now you may think this is odd. Your unemployment rate, here you are, Southwest Indiana proper, and the labor shed is lower than it is in the U.S. overall. So you're thinking our employment growth rate is slower, but our unemployment growth rate is lower. I thought unemployment being low is good. It is, but I really don't like the unemployment rate as a regional indicator because it can be affected by people leaving. So if you have a plant that closes, and instead of staying here and trying to find a job, they leave elsewhere and get a job, then they're not counted in the unemployment numbers because they're no longer here. So that may be a little bit of what you're seeing in these two indicators. Annual average wages. Here you're looking at wages that are about 45,000 compared to a little above 40,000 in the labor market, considering the whole labor shed, and then lower than the U.S. numbers. A couple of reasons for that. The first is that you have a lower cost of living. So up here now I'm showing you your cost of living relative to the U.S. So this is saying Southwest Virginia, if your wage is $44,000, then if you were to move someplace in the U.S., on average, you would need to be making $53,000 to live at the same standard level that you're living here. So that's one of the factors that you can use as making sure that if people are leaving this area, that they know they're going to have to get a much higher wage to live with the same living standard that they have here. Another issue in terms of the average wage being lower than the U.S. is the mix of industries you have. So now here I'm showing you the percentage of employment that's in each of these major industries or sectors. Construction, here you're looking at Southwest Indiana in orange, 5.8%, 5.4% in the labor shed, and then in the U.S., only 4.9% of all jobs are construction. But the real point here that's driving the difference is manufacturing pays better than average, so that's good. This is contributing to higher average wages in your region, but finance, insurance, and real estate, FIRE, the percent employed in that sector is much lower, and that typically pays fairly good wages. PBS, professional business services, is also lower and usually pays good wages, and so those are some of the things that are bringing your average wage down. It's the mix of industries that's doing that. PBS would be things like accountants, lawyers, engineers, consultants, and in general, those are high-paying jobs. Now, drilling down a little bit more onto some of these drivers, the manufacturing industry, as I said, is kind of volatile. The recession is not showing up, but it was right here. So you could see the decline that we've had and then the increase. So employment in manufacturing, since it's hit the trough, the bottom, has increased 2,600 jobs in this region. And that's pretty good. That's an 11.3% gain, more than double what we've seen in the nation over that time, 5%. So you've got a nice mix of manufacturing industries that has been recently growing. When we look at the percent change from a year ago, you can see again it's somewhat volatile, and you're in decline right now in terms of a percent change from a year ago, and it's the machinery and metal manufacturing industries that have been laying off, causing that decline to occur here. Manufacturing pays a very good wage. Notice here that the manufacturing wage is higher than the average manufacturing wage in the U.S., so that's great for this region. And as an example, computer manufacturing, on average, pays $117,000. So again, a very good wage, and for those parents who need to learn that manufacturing is a good industry, this is one good way to look at it. Now, drilling down into healthcare, it never did decline during the recession. It was the one industry that pretty much around the country continued to grow. And here now, going back to the start, 2005, of this chart, you've gained about 4,600 jobs in this region in healthcare, and that's about a 23% increase, but not nearly as fast as the U.S., which increased by 29% jobs in the healthcare arena. Wages in healthcare, here you can see yours, 47,000, just a little bit below the 50,000 that we see in the nation overall. If we took into account that cost of living, your wages would be higher. So when we get the medical university here that is graduating more doctors, that's something that you guys should be promoting, that your cost of living is lower if you stay here, even though the wages may be a tiny bit less on average. One other thing I did was to look at job postings to see how that related in healthcare. So I looked at the Southwest Indiana region, and this was about a couple weeks ago. I pulled open job postings, and what you can see here is that there were nearly 6,000 job openings just 2 weeks ago here in your region. And of those job openings, you can see at the top, the biggest was retail, salespeople, 354 job openings. And if you come down, you can see registered nurses, there were 160 job openings in that period. And then sort of down at the bottom of the screenshot, you could see the two employers with the most job openings at that time were Deaconess Health System and Ascension Health, with nearly 300 job openings just a few weeks ago. Another thing that I looked at, in all of those job openings, what are the certifications that the employers were requiring? And again, it becomes evident that healthcare is important. Here you can see 122 of those job postings mentioned that they'd like the person to have CPR. RN was next. Then here's a commercial driver's license, LPN, basic life support, certified nursing assistant, first aid certification, and then CPA, that's not health related. I also pulled just this morning how many job openings are there in this region for production occupations, and it was nearly 300, and that's as of today, just for your region, not the labor shed, but just your region. Sometimes we look at clusters, so these are clusters of industries together to give us a sense of whether you have any strong competitive advantages and how those are positioned. So here are a couple of things to look at. The size of the circle represents a location quotient. If the location quotient is greater than 1, that means you have a higher percentage of workers in that region or in that industry than we have in the U.S. overall. And when you have a competitive advantage, some regional economists will wait until you have 1.25 LQ to say it's a competitive advantage. That means it's easier to attract other firms because you have the training providers here, you have the suppliers here, you have the workers here. So when we look at something like this, on this axis, we're looking at forecasted employment growth, employment decline, and then we have wages. We like to see the biggest circles over on the right-hand side because they pay high wages and they're expected to grow the fastest. So some of your competitive advantages, auto with Toyota, I'm sure, plays a big role there. You have pharmaceutical, you have coal oil power with utilities being in that area, and then chemical. Notice some of these larger circles are on the expected to decline employment side because of expectations of continued productivity gains. Now, overall, I'm showing you total employment for the labor shed by major industry to give you an idea of how many people are employed in each one of the sectors instead of just looking at manufacturing and healthcare. And here at the bottom, what I'd like you to notice first, 311,000 workers, average annual wages of $41,857, and I'll address the others in just a minute. But here now I've highlighted the 3 industries that are paying the highest wages in this region. The highest wages, management of companies and enterprises. So these are sort of corporate headquarters or regional headquarters, so no real surprise there. Utilities pay a very high wage, about $89,000, and mining and quarrying, gas extraction pays a fairly high wage as well. And now I'm highlighting in red the location quotient. So again, greater than 1.25, you have a competitive advantage. So you see these 2 here, utilities and then the mining are fairly high. The other one that was high is manufacturing, and it pays a wage $53,000 higher than the average in your region. Now I'm highlighting how much has employment changed from last year. The greatest increase in employment has been healthcare, and then behind that we have retail trade, some other areas with increases in professional, scientific, finance, and insurance. But then you also have some areas that we're seeing a decline in employment. This one here, other services, that's actually government. And another larger decline is in the utilities area, 671 decline over the past year. More importantly, perhaps, is looking to the future. So what is the forecast for the next 10 years? And over the next 10 years, you're expected to need 4,632 people because businesses are expanding. But in addition to that, you're expected to need 76,000 people because individuals in current occupations are retiring or moving to different occupations. We heard this earlier, I think, from Dean. We have a lot of people who are starting to retire. So notice this number, 76,000 people needed, and your current employment base is 311,000 people. But in addition to that 76,000, another 4,600 needed because of expanding. And another plug for the manufacturing industry, if I can find it, is expected to decline by 5,000 workers because of some jobs maybe going overseas or because of productivity gains. However, it needs to fill 12,000 positions due to retirement. So there's some very good, high-paying jobs out there for people who want to move into the manufacturing industry. One other thing to point out here, the annual average growth rate expected for this region based on your current industry mix is 0.1%, annual average over the next 10 years. That compares to 0.7% in the US. So given your current industry mix, job growth expected to be slow here. One other plug for the manufacturing industry, I just pulled open the top 10 paying manufacturing detailed industries within that sector, or at least at the 4-digit level, and notice some of these wages. The lowest paying one was $77,000, the highest paying $148,000. Some here, motor vehicles, nearly 6,000 people, $78,000 average wage. So yes, again, there are some very good opportunities in the manufacturing industry. Now, we economists mostly talk about industries, but it's really occupations that are more important because we all think of the occupation we have. I'm an economist. Someone might be a finance manager or working in other occupations. But here now gives us an idea of how are the occupations growing that are tied to all the industries that we have in Southwest Indiana. So here I've highlighted now those that pay a much higher wage than the average. Legal jumps out, management jumps out as expected, architects and engineering, life physical sciences, computer and math occupations, healthcare practitioners. And those are broad categories. We really need to drill down deeper. There are 840 or so detailed occupations. I can't show them all, so I've just got the top 20 here. And when we look at the top 20 occupations ranked by employment, I've highlighted those that make greater than the average wage. Registered nurses, of course, come up. You've got truck drivers that come up. general and operational managers, which would be in manufacturing, and first-line supervisors, which again would be in manufacturing. So one last item in closing before we open to questions is I wanted to take you through an example of preparing for a firm expansion and things that Greg and his team think about in terms of, do we have the workers needed? Because that's one of the things that when we work with expanding firms and when we work with economic development groups, they want to know that when they move to a region, they're going to find the skilled people they need. So I just picked one, resin and synthetic manufacturing, rubber manufacturing. Let's say a firm of 100 people were considering coming to your region. Would you have enough proof for them to feel good about moving here? So the one thing that we'll do is we'll look at what sort of occupations do they need. So here I'm looking at the top 100 occupations. They're going to need 13 chemical equipment operators and tenders. You have 460 that work here is our estimate. You have 7 unemployed. The average wage you pay here is $63,000. The average U.S. wage is $50,000. But there are other occupations here that pay a lower wage than the average U.S. And then we have this employment extended. I'll come back to that, and the unemployment extended. But the really important piece is this potential candidate to opening ratio. So when we've worked with expanding firms, they've said to us, we like to see 50 people employed or unemployed for every one person that we're going to hire in a certain occupation. So if this is green, that means you've got plenty of workers. If it's orange or light red, it means you're not quite there. So you've got to prove to them that if they do come here, you're going to be able to find those workers. So this employment extension, even though we only have a 36-to-1 ratio in terms of chemical equipment operators, we have 635 people that are in occupations that could be trained to go into this chemical equipment operator. And here's a list of those occupations. We come up with these based on skills and transferable skills. And you can see the different occupations that they are in now, but could be trained. So if you were Greg standing in front of this company, you would say something like, I'm working with our workforce and training providers to identify these people within our region, and we'll train them up. They typically make less money, so they have a motivation to go into this new occupation. And then the other thing is, in terms of pipeline, chemical engineers I highlighted, you're short on them as well. So in this case, another thing that you can do is you can look at the community colleges and the universities within the region. Do we have a pipeline of workers that are being produced that are coming forward? And so when I clicked on this chemical engineers to look at the schools in the region, are they providing the curriculum, here's what came up. We have one university who does have the curriculum to become a chemical engineer, but no one is enrolled. So this is where businesses need to be working with the educators, the training providers, the community colleges, and letting them know these are the occupations we need, these are the certifications we need, so that they can make sure that the curriculum's available, that students are enrolled and know it, so that when Greg and his team bring in these potential companies, they'll be able to show the pipeline is here. So in conclusion then, national economy is growing. There is no signs of imbalances in the economy that would point to a recession coming anytime soon. We're about 18 months of being in the longest expansion our country has ever seen, and expansions don't die of old age. So at this point, things look good. If we saw some of the tax cuts pass that Congress is talking about now, I think that'll go a long way of taking us to this record expansion. Southwest Indiana is growing slower than the nation, clearly in the numbers. The largest sectors, education and healthcare. It provides consistent, stable growth. It pays relatively well. The job postings and the forecast for growth say that it's giving many opportunities for residents and people around the region. Second largest sector, manufacturing. Sensitive to business cycles, but it pays a very good wage. So in concluding then, as I look at it, the talent and skills of your workers are your region's greatest assets. And what I've given you now is a lot of data, and data can take you to a potential solution, but it takes leadership to transform a strategy into action. So the last comment I want to leave you with is your job is to make my forecasts wrong. My forecasts are based on your industry mix now, but if you bring in other industries, if Toyota brings in more suppliers, then your manufacturing growth is going to be much greater than what we're forecasting here. So thank you. Sit down.
So we're going to take some questions from you. We're going to sort of like a fireside chat. Hopefully these lights won't shine on my head and blind some folks out there. But let me start off with one question for you in particular as it relates to, and we want to take questions from you. By the way, if you have a question, just raise your hand and one of our team members will come by with a microphone. So we're hearing a lot, in particular with manufacturing. Manufacturing is the largest part of our GDP. But there's this feeling that within the next decade or so, you're going to see at least 25, some economists I've seen is 40% of the manufacturing jobs go away. It'll be replaced by technology. Do you think we're at that point that we're actually going to see that very thing? Or do you consider that possibly that manufacturing will just begin going again offshore where there's availability of labor?
Yeah, no, I don't agree with that. And even in the U.S., the expected decline is not that great. And the recent forecasts have revised the numbers to be even a smaller decline than previously expected. I think we're seeing some manufacturing jobs coming back, and in the rural areas, you're in a good position to do that because of your lower cost of living and the available workforce that have the skills in that area. I think with some of the policies of the new administration, if we do see a repatriation of some of the dollars, that will certainly help here. And we're seeing growth in more of the advanced manufacturing. So even if, one example in Canon located the printing company located in the Hampton Roads area maybe 10 years ago, and they opened a plant and that makes the toner, and now they they employed about 200 people, and the new plant they opened makes the same amount of toner but with just 50 people. So even though we're being more productive, we're seeing some more firms coming and opening here to take advantage of that productivity. So no, I'm more optimistic about the manufacturing sector than some.
Testing. Hello? Okay. Hey, with the coming of artificial intelligence, and I've heard it said that, computers and robots will be more precise and better surgeons than the most accomplished surgeons. How do you think that artificial intelligence is going to affect our job mix, and where are we going to have gains and where are we going to have losses? And does that result in a net loss overall?
Yeah. Artificial intelligence. So with artificial intelligence, there's still going to be people running those machines. There's still going to be people doing all the coding that need to know the math. And just with the small company that I have, it's just amazing to me the machine learning, looking at data and looking at job postings and pulling information in, how much math the people need to have and computer skills. So I think we're going to see a shift toward needing people with higher skills. And in fact, I was reading an article from the Labor Department on the way up here, and they were looking at employment by education typically required in an occupation. And for all occupations that need a 2-year degree or more, we see more people employed right now than we did prior to the recession. For those occupations that only need a high school degree, we're employing less people than we did before the recession started. That sector has not come back. And so basically what you're seeing and what studies have showed is it's the occupations that do things repetitively that are being taken over by machines. And another example would be Amazon, where now maybe we won't have as many cash registers, people at the cash registers, because they're creating something where you can just drop it in the box into your basket and it charges you for it. You take it out of the basket and it takes it back out, so we don't need people at the register. So again, I think we're going to need more people with college degrees. But having said that, for the manufacturing sector, there's all skill levels are used there. So not everyone needs to go and get a college degree. There are a lot of opportunities for people with just a 2-year degree, some of them paying better than what you can get when you come out of school. and have a bachelor's degree, such as machinist is a good example.
I have a, excuse me, I have a question regarding gig workers. These are the stay-at-home people working out of their homes. They say there's like 30 million now people that earn part of their earnings working from home. And back to the broadband initiative you have going on here, Greg, was part of the question. But where in your data do those people show up? I guess, Chris, is what I'm wondering.
Yeah, that's a tough one. And I think the BLS is just starting to survey. So they have they do a monthly labor survey when they talk about the unemployment rate. And they're just formulating some questions to start asking around that, so we don't have a good sense of what that is right now. We may see that right now in terms of those people working part-time, and that has stayed kind of high. So some of those part-time workers may be a full-time job plus a gig worker. But so maybe a year or two and we'll have some good data for that.
Let me ask you a question. So, and this has to do from an economist's perspective. Right now, many communities across the country are going Amazon crazy, trying to land the second headquarters of Amazon. From an economist's perspective, as communities are bidding against other communities for this, I mean, what do you see would be an adequate return on investment for the kinds of things that, if you look at Foxconn, for example, and there's been some, whether or not Foxconn will actually deliver for Wisconsin, particularly because of what they've not done in Pennsylvania, that was a $3 billion incentive package. So I think the anticipation for 50,000 workers from Amazon is going to be something significantly more than that. I mean, from a community standpoint, or from a state standpoint, will you ever see a return on investment for that kind of public investment?
That's a tough one to answer. We have had at least one state come to us, or one region, and say, would you help us prepare for this, to submit? And the information that they're required to submit is kind of odd to me in that they're just asking for total population. They didn't point out any occupations that they need. They just want to make sure they're in a large population area. But the jobs are going to be very high-paying job, 80, 90,000 or more on average. And so one of the people we're working with on this one potential bid, and he's thinking about the incentive piece, and we said, how should we think about the incentives, because they want us to figure out the return on investment, because they have to take it to the county and to the state to see if they can get the money to see what the economic and fiscal impact is. And his response was, the state should look at the biggest thing they've ever done in terms of an incentive and just multiply times 10. And then we could start to work backwards and see. So I sort of, when I look at all the work that the economic developers are doing a great job, and all the money that goes into incentives, sometimes it makes me think of marketing. You may just hit me right now. But you remember in economics, you have that dead weight available of our brand, and to try to attract them to move here.
Other questions? There has to be other questions that anybody else have. Anyone?
Well, you know lunch is coming up
I know
next.
lunch is coming up, so if not, we can end a little bit early. But let me just sort of end on this. If you gave us some things and we look at, so think about this in terms of, yes, we may not see the kind of growth that we want to see just right now in terms of job growth, the health of the economy, replacement number of jobs, almost 76,000. If we were going to be focusing on one thing or possibly two, you're saying over the next 10 years, we most assuredly need to be focused on this. In your opinion, what should we be focused on?
It would be making sure that whatever is your target in terms of industries coming in and the industries that are currently working here, having a workforce that has the skills needed. So look at what is the gap between demand and supply, trying to get the word out to the students and to the workers who are leaving certain occupations. Here's what's going to be in demand in the future, and here are the training that I need to have to get that job. Talk to your businesses.
So we're going to end a little bit early. That gives us some extra time, and we're going to do something a little bit different for our lunch. And that is unusual for conferences. And we're going to be feeding you by food truck. And these are food trucks based in here in our market. And we really want to thank the DoubleTree Hotel for allowing us this. You received a menu when you came in. So you could get River City Gourmet Dogs, Nam, which has more of an Asian fusion kind of food feel, or Flying Pigs Barbecue. You have a lunch ticket. You take the lunch ticket out there, you go to the food truck that you want to, give them that lunch ticket. There's no cost for it. Come on back in here, refreshments, drinks will be back in here. And then what we're going to do, we're going to begin at 1 o'clock with the next session. So thank you very much.